This is how non-finance background individuals can assess the financials of a state-owned enterprise to see whether the state-owned enterprise is financially healthy or not. One is by looking at the statement of profit or loss. Now, with this one, you are going to assess whether the state-owned enterprises at the end of the period and the review is posting profit or loss. And you would look at the sales, the expenses, the taxes paid, the finance cost or the interest charges. Then you know whether the entity in that period is making profit or loss. Now, with this one, you can look at the trend in the sales. That is, every year the sales that the entity has been making, the revenue, is it increasing or decreasing? If it's increasing, it's a good sign, but if it's decreasing, then it's something for concern that we need to flag and look at why that is happening. You also look at the profit before interest and tax. Before the company pays its interest or borrowing cost and taxes, is it making profit or loss? If it's making profit, then it's a good thing. But if it's making a loss, then we need to, red flag it, because we need to assess which component in these operations is causing the loss. Now, the last layer is the profit after tax. Is the entity posting profit after tax, or it is posting loss after tax? If that is it, then what is causing? Is it the tax which is causing the loss, or is the interest payment which is causing the loss? If it's the interest payment, then we need to look at to what extent the company is able to cover its interest. Then will also give us a sign of how the company is indebted, or to what extent the company is indebted. The next thing that we can look at is by looking at the statement of financial position, which mostly is termed as the balance sheet. Now, with that one, we have the asset column, the liability column, and the equity column. Now, the first thing is that if we deduct the liabilities of the company from its assets, is it positive or negative? If it's negative, then it means that that organization is having a negative net worth at book value. That means that the cost of its liabilities and the its assets value, and you match it, you will have negative. Then it's a sign that that company is highly geared. That means that on face value, if we sell the assets of the company, we will not be able to settle the liabilities of the company. If you want to go further, we can look at the current assets and the current liabilities. Now, the current assets and the current liabilities, when we do the arithmetics, then we get what we call the working capital. If we compare the current assets and the current liabilities of the company and it's positive, then it means that it's good. But if it's negative, then there is issue. We need to red flag it. So let me know what you think we can look at to know what to know whether an SOE is financially sound or not. Let me know in the comment section.